Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to Money Talk, Asia's business and finance podcast, as we reach the middle of the week on Wednesday the 26th of August. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 100 million customers across 13 countries. In today's business and finance headlines, US Treasury Secretary Scott Bessent's threat to unleash an economic D-Day against Iran risks setting the US on a collision course with China, Iran's main trading partner. Bessent promised an economic onslaught against Iran's financial connections around the globe and unveiled dozens of new sanctions, but the main thrust was threatening secondary sanctions against companies and countries that continue doing business with Iran. China defended its cooperation with Iran yesterday and warned of potential retaliation, saying it will take all necessary measures to firmly safeguard its own interests. Canada on Tuesday announced retaliatory tariffs against the United States, matching dollar for dollar the 50% duties that Donald Trump imposed over the weekend after a breakdown in trade talks. Ottawa's new tariffs encompass more than 700 US goods and are worth about $20 billion US, mirroring the size of Trump's latest import taxes on Canadian wine, cement, hockey sticks and other products. A Bank of Japan measure of underlying inflation remained above the central bank's 2% target, supporting widespread expectations of a September rate hike. The consumer price gauge rose by 2.3% in July from a year earlier, according to the BOJ. Traders are pricing in roughly an 80% probability of a rate increase when the central bank delivers its next policy decision on September the 18th. Bitcoin yesterday rose above $80,000 for the first time since mid-May, after rallying 23% last week, the most in about 3 years. Scott Bessent's bond purchases are boosting the investment case for Bitcoin, along with gold, by reviving the dollar debasement trade. Bitcoin was originally created as a way to escape fiat currency debasement and inflation driven by central bank money creation. Spot Bitcoin ETFs had their strongest weekly inflow in 10 months last week. On today's programme, I'm joined by Kuijs, Chief Asia Economist at S&P Global Ratings, and Nick Marro, Principal Economist for Asia at the Economist Intelligence Unit. With a view from Japan is Dan Kerrigan, Managing Partner of Ohara Capital Partners. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks and bonds were firmer Tuesday, shrugging off geopolitical tensions over Iran and an escalating trade war with Canada. The S&P 500 index gained 0.33% to close at 7,677. The Nasdaq Composite advanced 0.7% to 26,151. The Dow was up 160 points or 0.3% to close at 53,577 and notched its third straight winning session. Shares of Nvidia ticked 2.2% higher ahead of its earnings later today. Nvidia shares had fallen for 7 straight sessions, the longest run of losses since 2022. Treasuries extended gains after CNBC reported that the US Treasury Department could use its $1 trillion general account to fund bond repurchases. The yield on 10-year bonds fell 7 basis points to 4.63%. The 30-year yield dropped 6 basis points to 5.17%. In the currency markets, the US dollar index retreated 0.1% to 98.91. The Japanese yen weakened 0.1% to 159.25 yen per dollar. The offshore Chinese yuan weakened 0.1% to around 6.72 renminbi per dollar. Gold, a beneficiary of the so-called debasement trade, extended its winning stretch of gains to 5 days. Spot gold settled 0.1% higher at $4,658 an ounce. Bitcoin, another beneficiary of the weak dollar, extended its recent rally to briefly climb above $80,000 for the first time since May. The cryptocurrency rose as much as 2.9% to $81,257 on Tuesday, a level last seen on May the 15th. The cryptocurrency was last trading at $78,100. Brent crude oil futures dropped 3.9% to close at $88.58 per barrel. Asia Pacific markets were mainly higher Tuesday. Japan's Nikkei 225 closed 0.5% firmer at 65,856. South Korea's Kospi rose 0.7% to 6,743. Chinese markets were little changed amid concerns over growing Mideast tensions as the US rolled out global sanctions focused on Iran. Hong Kong's Hang Seng Index was almost flat at 25,511 on Monday. Mainland China's CSI 300 closed 0.2% lower at 4,552. Futures markets in Asia pointing higher at the open this morning. The Hang Seng in Hong Kong projected to start the day 0.5% firmer. Looks like the Nikkei 225 in Japan is going to rise 0.2% at the open. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
We have two economists with us this morning, so we're going to have an economic discussion, but will they agree? Let's find out. First up, we have with us Louis Kuijs, who is Chief Asia Economist at S&P Global Ratings. Morning to you, Louis.
Morning, Peter.
And also with us is Nick Marro, who is Principal Economist for Asia at the Economist Intelligence Unit. Morning to you as well, Nick.
Good morning, everybody.
Now, look, I'd like to start off by asking you both about the Asia-Pacific economy overall. I hear a lot about the K-shaped economy, where basically the economy is running at two different speeds. The artificial intelligence boom, on the one hand, is boosting exports and production, but then we have higher inflation dragging on growth from the Middle East war. We're seeing certain markets out here doing very well from the AI boom, particularly Taiwan, South Korea, parts of Southeast Asia. I mean, Louis, let me start with you and ask you: are you seeing this two-speed economy around Asia, and in particular, what sort of impact is the AI boom having on Asia? Because you get the feeling that without it, the picture would look a lot worse.
Yeah, Peter, definitely that AI-related tech export boom is a huge impetus for certain parts of industry in the APAC region. And myself, I've also been, advertising this view that other exports are much weaker. And so there is quite a bit of truth to that K-shaped narrative. However, it is also true that if you look at some of the economies like India and Indonesia, especially India was singled out at the beginning of the war, of the Iran conflict. It was singled out as an economy that was going to be really very, very badly hit by the energy stress. Well, to be honest, if you look at the domestic economy in India, it is actually moving along pretty strongly. And so I think one aspect, of course, has been that so many governments in this part of the world have actually suppressed the impact of higher oil prices. They have subsidized it or asked their companies to basically bear the brunt, their state-owned oil companies. So, the tech export strength is a huge driver, but outside of tech, it's not that the economy is totally moribund or so.
Okay, well, Nick, what are your thoughts on this? We're seeing the AI boom probably helping us here in Asia dodge quite a sharper slowdown, but you also get the feeling, don't you, that the headwinds to growth are mounting.
Yeah, that's right. And if you look at, say, aggregate Asian exports, it's not necessarily, chips are booming and everything else is falling off a cliff. It's just that chips are booming and everything else is still growing, but being massively overshadowed by the booming AI-related export drivers. So, I mean, if you look at Taiwan, for example, Taiwan's maybe one of the best poster children of what's going on here, in the sense that it's semiconductor-related sectors, it's other kind of technology component sectors are all just doing really well. I think what's interesting, however, is that we've seen a stabilization in private consumption over the last couple of months, but a lot of this seems to be very much tied to what's happening in equity markets in Taiwan. But then as equity markets have come under a little bit of turmoil, that lift to household spending has also kind of lost a bit of steam there too. So we just got retail sales data for Taiwan late Tuesday, and it illustrated that in year-on-year terms, we saw pretty significant growth, but that was because year-on-year terms last year were just so weak, and so that means that we have a very low base of comparison to use economics terms. And in month-on-month terms, actually retail sales fell, and so that means that when you even look at some of the sectors that are not directly tied to what's happening in AI, but are influenced by it, any minor gyration can have somewhat of a disproportionate effect in terms of what's happening for these growth drivers. Another good example is China. I'm mentioning it only because China's economy is a lot more diversified than, say, an economy like Taiwan's. But even there, we see continued resilience in exports, particularly from the price angle. So it's not necessarily export volumes, but export prices are doing well, and that's inflating the value figure. But the domestic economy, I'd say there is just not doing very hot. We had the latest data print out a couple of weeks ago, or a week ago or so, just still showed a strong contraction in fixed asset investment, kind of a deceleration in industrial value add. To me, that shows that this imbalance is still very much an area of concern in an economy as big as China's. And I think we can kind of use that to anchor our views for the remainder of this year, in the sense that the drivers of Asian economic growth are still very much coalesced around what's happening around AI. And if we're to see any kind of receding from that narrative, there could be some disproportionate effects.
Well, Louis, let me get your thoughts on China. Let's talk about China a little bit more, because obviously it's the biggest economy in the region. The data that we had for July wasn't great, was it? Retail sales have almost ground to a halt. Investment is negative. Unemployment is increasing, and many people reckon the real unemployment rate is a lot higher than that official number. Are you seeing a bit of an economic sort of funk in China? And if so, what can be done to get the country out of it?
Yeah, Peter, I'm happy to talk about China. I really want to just put on the record that I see things a little bit differently than the two of you on that issue of how strong is the divergence between the AI-related industry sectors on the one hand and the rest of the economy. I just looked at domestic demand in the second quarter data across the region. And as I said, I see quite a lot of strength in these economies. Like, again, India was supposed to be among the worst hit economies. I don't see a lot of weakness over there. Same for Indonesia. So, that's one thing. On China, absolutely. There is an awful lot of weakness on the domestic side. Domestic demand is weak, dragged down by the continued slide in property, pretty weak confidence. And also, I think that's something that not enough attention is being paid to, a macroeconomically ill-timed fiscal contraction. We're having a fiscal contraction this year with fiscal revenues pretty solid and fiscal expenditure basically flatlining. So that is an additional drag on growth in China. From what I see, there is a little bit of interest in Beijing among policymakers to release some targeted support here and there, but nothing very significant. So that storyline is probably not going to change very much in the coming 6 months.
Well, look, let's carry on disagreeing. It makes it a more interesting program. Nick, what can be done because we've got the National People's Congress meeting, the Politburo meeting, also going to take place this week. There does seem to be a real reluctance, doesn't there, to take any action to stimulate the economy. What the Chinese authorities seem to want to do is to allow these, the revolution that's going on in the tech to really permeate through the whole economy, in the hope that will boost other sectors. Do you think that's going to work, or does China need to be more proactive in terms of trying to boost growth?
Yeah, well, I mean, first off, I think you might have jinxed it, Peter, in the sense that you wanted us to disagree, and I actually agree with Louis here, in the sense that we can draw a lot of what's happening here to that fiscal side, that fiscal retrenchment side. I think what we're expecting from policymakers is the signals they're giving us are they're going to double down on existing measures. There's been language in, say, some of the Politburo meetings coming out that the policy tools that have been introduced haven't been fully or properly executed. And we're not really seeing any new policies coming out, but rather an emphasis that the existing support has to be deployed first. And so that suggests that there's still a degree of kind of conservatism when it comes to policy formulation here. And we're expecting policy support to remain relatively limited. So we're not expecting any significant expansion of, say, consumer subsidies following the latest Politburo meeting in July. And I think this kind of bias towards a bit more of a restrained approach is going to persist through the remainder of this year. I think in terms of what needs to be done, the first thing is I would say that there should be a stronger fiscal impulse. There needs to be a bit more of a proactive, pro-growth fiscal stance by officials, in the sense that it's not necessarily just an issue around policy not being deployed. It's an issue around confidence. It's an issue around the continued woes in the property sector. It's an issues around the whole, and involution kind of crisis of consumer confidence that's gripped the kind of Chinese economy by the throat over the last couple of years. And so I'd say there's actually a lot of room for policy innovation here, but whether the policymakers are going to actually execute that is a separate thing, and we're expecting them to be a bit more restrained.
Louis, do you agree or do you disagree? What do you think needs to be done here by policymakers? Do they need to be more proactive?
Well, so I unfortunately agree with Nick on what the outlook is. So we also don't really see a lot of appetite for strong new measures. We officially, in my company at S&P Global Ratings, we don't really give advice on policy. We just try to forecast it. And so what should they do, right? It's up to it's really up to policymakers. But I would say that you asked, right, will that idea of letting all those productivity and technological advancement take place, let that transition in the economy on the supply side take place, that will eventually, get domestic demand going. That is going to be a very supply side driven process. If that's really all that they're going to rely on, then that nature and that relentless competition that Nick mentioned, that is driving down prices and profit margin, is going to be with us for a very long time. So that would be, in my view, a not very favorable outlook for China and the rest of the world, because there are a lot of international spillovers of this as well.
Okay, well, let me ask you both about the second biggest economy in the region, Japan. A key Bank of Japan inflation gauge stayed above the central bank's 2% target in July. This is the BOJ's adjusted core measure, which strips out fresh food and also the effects of government subsidies. It rose 2.3% from a year earlier. It's a measure that Governor Kazuo Ueda introduced earlier this year to give a clearer read on inflation trends. Nick, inflation does seem to be moving higher, doesn't it, in Japan?
It does, yeah. And this might be one area where we finally disagree, just because our Japan team is somewhat outside of market consensus here in terms of how they're interpreting the data and what this means for, say, the BOJ decision. And so our team, when we look at the inflation print, we are still seeing most of the price growth being driven by supply side factors. And so this could be compounded by pressures from imported energy, from weakness in the yen, and that kind of pass through to headline CPI. As a result, our team is still relatively benign in terms of how the government's going to respond to this. We're expecting the BOJ to kind of look through the underlying drivers here and still see that demand-led inflation is still not really where they want it to be. And so although we are still expecting a rate hike in October, we are expecting them to keep rates on hold in September. And so a little bit out of market consensus there.
Okay, well, Louis, what do you say to that? What's your outlook for Japan?
Our outlook is not wildly different from the one that Nick sketched. I read in the international coverage of Japan, I read a lot of people who feel, I've read a lot of people arguing things like the Bank of Japan is so much behind the curve and the Bank of Japan is going to have to take measures in order to let the currency strengthen. I personally don't think the Bank of Japan has been behind the curve. I think that they're actually moving along quite to a gradual increase in interest rates that is also quite a bit more sustainable, financially sustainable, when you think about corporate finances or the government than many people in Japan itself worry about. And secondly, I also find the Bank of Japan is a central bank of a very large economy that is not super open, where the outside world doesn't play a huge role in the economy. They're not supposed to care about the exchange rate. They're also not responsible for it. It's the Ministry of Finance. So I would say they will continue to look at those things like underlying inflation trends as they think about their rate decisions. In our view, they will continue to gradually increase interest rates with a terminal rate of around 1.5%, which I think is lower than what some other people expect it to be. I don't think that the equilibrium interest rate in Japan has moved an awful lot in the last, say, decade or so. So that's a little bit how we look at the future. And then, whether they're going to increase in September or October is not really that important to me. I look at that terminal rate of 1.5%. We're now at 1, so we have 2 more hikes to go in our view.
Well, let me push back a little bit on that. I mean, you say the Bank of Japan isn't behind the curve and they're not responsible for the exchange rate, but surely they've got to work with the government. If the government wants to boost the yen and it's got the support from the US Treasury of doing that, unless the Bank of Japan gets on with it and raises interest rates, all this is going to be to waste, isn't it? They really need to not just raise rates once, but maybe raise rates several times and even 1.5% is not a particularly restrictive interest rate. So shouldn't the Bank of Japan really get on with it and raise rates in a maybe more aggressive fashion?
I don't know, Peter. Do you see the ECB, moving its policy rate because of currency considerations? It's not supposed to. And so I don't really see a lot of interest among BOJ senior officials either to do that. I'm sure that other things being equal, they would like to see a stronger exchange rate, but they need to, as I said, they are a central bank of a large economy where the outside world doesn't matter that much, and they need to execute monetary policy with domestic considerations in mind, basically inflation and a little bit growth. And that's what they've been doing, and I think that they will continue to do.
Well, Nick, what do you think here? Is the BOJ behind the curve? I mean, if they really, Louis says it's not their responsibility to boost the exchange rate, but clearly the government wants the exchange rate boosted and the US Treasury wants the yen to go up as well. The only way that's going to happen, isn't it, is not a 25 basis point increase. That's not going to do it. It needs the BOJ to be more forceful. And in many ways, that will be a good thing for the economy because people in Japan are feeling the impact of these price rises.
Yeah, and I can be sympathetic to that argument in the sense that, you need to have, very strong signaling where even if, managing the currency isn't really part of its remit, there are actual real world implications of that, given that the latest rounds of intervention haven't really kept the yen at a sustainable level and kept it from kind of further depreciating. I will say, however, and this is also somewhat to Louis' point, but I mean the BOJ is independent, right? They have to conduct monetary policy without considerations from either the Japanese government or, especially kind of policymakers from overseas. And so, there's a very fine line in terms of the BOJ necessarily receiving pressure from the Japanese government and then executing on that pressure because they do need to maintain that position of being independent in its decisions. I mean, that being said, please don't kill me, but I will say that we're also expecting a similar terminal rate in terms of the BOJ moving rates eventually to 1.5%, although our view is that this won't happen until the first quarter of 2027. But to your point, Peter, I think regardless of what the BOJ should do versus shouldn't do, one thing that has to be important is both credibility and what that credibility sends as a signal to investors. Again, even if the currency isn't the main point, the main objective here for the BOJ, it is a residual of these decisions. And I think when we talk about this topic specifically, having very strong confidence in messaging and making sure that the BOJ is giving a very clear perspective on its ability to handle price pressures in ways that will then influence the currency. Those are all things that are important. But again, I think they're not necessarily the driving mechanism for the BOJ.
Louis, you and Nick seem to be agreeing far more than I thought. So I'm sure you're ganging up on me. What do you say, Louis?
No, it's it's gagging up on you is actually fun. But no, seriously, of course, the Bank of Japan I'm sure that in current conditions they would rather see a stronger exchange rate because everybody is looking at it. But I also honestly think that people are exaggerating the importance of the weakness and the significance of it. When you think about that imported inflation that a lot of people are talking about, right? There is that argument that the exchange rate weakness is amplifying the impact of higher oil prices, and that is a reason to really look at that exchange rate. Well, if you look at the year to the 12 months to June, we had a 7% weaker exchange rate in Japan and a 63% higher oil price. So the importance of the yen is something like 1/9, 1/10 of that compared to these oil price increases. That just again to me underscores that role of the yen in these transmission channels is a little bit overplayed.
Well, look, let me see if I can get you to disagree on a couple of international considerations then. I mean, Nick, first of all, we have now Scott Bessent's economic war against Iran. He seemed to be yesterday talking really, or it was more a series of threats against countries and companies if they continue to do business with Iran, rather than any concrete economic sanctions or anything particularly new, wasn't it? But of course, the big issue with that is China. China is the biggest trading partner for Iran, and if China isn't on board, then this is not going to work, is it?
Yeah, exactly. And I think that's why it's important to remember that a lot of what's happening right now is posturing and threats rather than actual implementation. And so if we look at U.S. trade policy over really much of the past year, actually, we see a much more restrained approach to tariffs, at least when it comes to rhetoric versus reality. A lot of the recent tariff announcements that we've seen, with Canada as the main exception, include duties that are not really going to be adopted until after the U.S. midterms. And so that includes things like duties on drones, duties on polysilicon and their derivatives. The reason for that is that the U.S. administration is still very concerned in terms of how tariff pressures could be seen as exacerbating cost of living problems in advance of the midterms. And when you look at kind of polling regarding Donald Trump's stewardship of the U.S. economy, he is polling very negatively. I mean, the midterms are very much the contest for the Democrats to lose. The reason why this matters for trade and tariff policy is that in some ways we still expect there to be a degree of restraint, not least because it's not entirely clear what legal mechanisms the U.S. administration would have to actually execute these, say, secondary sanctions. I mean, I guess you could activate the treasury lists, but after the U.S. did that against Hongli, the Chinese petrochemical giant, in May, China responded with its blocking statute, which set the U.S. and China up for kind of these dueling sanctions regimes, which the U.S. has since never tested. And then, as you said, Peter, this is all in the context of Xi Jinping's expected visit to the U.S. in September, where we are still seeing a lot of momentum on the working level to try and maintain that stability and ensure a successful visit, not least because the U.S. is still toying with tariffs on overcapacity, not just on China, but for all the other countries that were caught up in that investigation, which could result in tariffs of around 7.5% based on the 20% thresholds or 20% ceiling that the two had agreed on last year. So what that all means is that yes, the U.S. has to move very carefully here. Unilateral action is not going to be kind of the panacea for resolving all of this dilemma with Iran. And indeed, like geopolitical constraints elsewhere, including the U.S.-China relationship, are going to really hamstring how the U.S. is going to move forward here.
Louis, what are your thoughts? Two big things going on. First of all, secondary sanctions from the US on countries that do business with China, but the big question mark over whether they will actually take any action against China. And then, of course, we've got tariffs increasing as well, haven't we? The latest bout, of course, against Canada, and Canada announced its retaliation last night. What sort of impact is this going to have on the region out here? What sort of concerns does it raise?
Yeah, I'm afraid I agree with Nick pretty much along on these issues. On these sanctions, right? The U.S. threatened, or I think they supposedly undertook, at least they said they were going to impose sanctions on countries that were trading with Iran in terms of oil before. They didn't really do that. So that really sets up the current episode in a way that you wonder if that is really something going to happen, especially vis-a-vis large countries. It looks like this U.S. administration is much more trigger happy vis-a-vis smaller countries than it is vis-a-vis larger economies that have a resilience and can fight back in a credible way. And on tariffs, it does look like we have reached somewhat more stable conditions where they seem to just want a certain amount of protection, not too many changes. And so, as Nick said, these 7% or so tariffs are meant to basically achieve previously agreed tariff levels. So, our view overall with regard to U.S. tariffs on Asia is that they're a little bit less likely to change significantly, both in terms of levels, but also in terms of differentials between the different Asian economies. So that provides some degree of stability.
Well, look, final question to you both. Let's see if I can get a cigarette paper between the two of you on this. Putting this all together, what we've just discussed, what do you think growth is going to look like across the Asia-Pacific region this year and maybe next year? Louis, do you want to start?
Yeah, on this, there are so many concepts of Asia. Do you include China? And how do you even also weigh it up? Our view is continuing to be that growth is pretty steady. I think we have growth slightly weaker than last year. We see a little bit of moderation, but we want to position ourselves as remaining quite constructive, quite positive on growth in the region. When we in the beginning of our discussion, I mentioned that AI is a huge driver, but it's not only about AI. There is also that domestic demand strength. So yeah, we continue to be relatively optimistic about Asia.
Okay, Nick, final word from you then. What are your thoughts about growth across the region this year and next year?
Yeah, sure. And then caveat, please invite me back. Because I'm just going to agree with Louis again. I guess I'll try and make it interesting by saying that maybe we are putting a bit more stock into what's happening with AI, and we're using this to anchor a lot more of our forecasts, in the sense that I don't think we're as positive about domestic demand as Louis and his team are. Not saying that we're very pessimistic about it, but we're putting a lot of stock into what's happening with AI. And so to recap, expecting regional aggregate growth to slow slightly in 2026 and 2027, but that's based on our view that global AI-related infrastructure investment is inevitably going to cool in the coming quarters, not because of any correction, but just because we're running into a very high, annual base of comparison from preceding quarters. And so there's going to be a mathematical slowdown. And as a result, that is going to weigh a little bit more on kind of the AI and electronics export-exposed economies in ways where we don't think domestic demand is going to offset fully those pressures. But again, it's still a very benign outlook. And when we consider our forecast now versus, where they were right when the Iran war broke out, we're feeling a lot more confident in terms of the landscape looking pretty stable.
Okay, well, look, I try my best to get them to disagree, but they ganged up on me instead. So thank you both very much there. You heard Nick Marro, who is Principal Economist for Asia at the Economist Intelligence Unit, and Louis Kuijs, who is Chief Asia Economist at S&P Global Ratings. A lot of fun that was. It's a Wednesday morning, which means it's time for our regular View from Japan. I'm joined this week by Dan Kerrigan, who is Managing Partner at Ohara Capital Partners. Good morning, Dan.
Morning, Peter.
I want to get your thoughts, first of all, on Scott Bessent's war with the bond markets. He seems determined to bring down long-term borrowing costs because he thinks the markets are focusing on the wrong things, like maybe deficits. What are your thoughts on what he's trying to do here?
Geez, like the mosquito in the nudist colony, where do we begin? You can go back to the Greeks, never get into a war with somebody who's more powerful than you. Should know that, for starters. And I don't see how you can either manipulate or influence a $31 trillion market. And especially with his background, the market always wins. And he's made a lot of money for himself in the private sector by understanding that. So I think we can look at what he's trying to do. I understand that 30-year yields back to the highs that were last added in 2007 is viewed as somewhat as a concern. But there are a couple of rejoinders to this. One, it's not the end of the world. If you look at the gap really between the regular treasuries and the inflation index bonds, it's really unchanged over the last 6 months or so. The gap is still about 2.3% or so. So we're not really, people fingering inflation or spiking inflation as the reason why yields are crawling higher doesn't really hold water when you look closely. Second point people are looking at is this $1.9 trillion in debt issuance from the AI developers, is this creating a higher yields? Is this crowding out the marginal dollar between the private sector and the treasuries? And that's really only worrisome if in a few years, if we discover that AI hasn't delivered on economic growth. So the jury's still out there, but you think you've got some of the smartest people in the world issuing debt in order to invest in things like data centers to support artificial intelligence. So, if I had to bet, my money's on the people issuing the debt. So that's something to be concerned about if it doesn't deliver, but it's too early to tell right now. And then I think something that is more credible is the deficit of the U.S. federal government finally starting to register here. We're back at about 6.4% of GDP. And with the savings rate of 2.8%, clearly that's unsustainable at this point. So we've got a list of reasons of things to be worried about. But you can see that whether it be intervening in the currency market or intervening in the treasury market, it's an exercise in futility. So we still really don't know what the new Fed governor's all about. I mean, he's been very reticent. He makes Alan Greenspan look like Alan Greenspan's on sodium pentothal almost. So we still don't have enough. And then the next data point really is next Friday when he's going to be speaking at Jackson Hole. So the markets are going to be looking at this. But I think just to really crystallize your point, I thought the most interesting thing to come about this was the public rebuke by Bessent's mentor, Stan Druckenmiller. It's almost like getting your knuckles rapped by the school marm saying, look, Sonny, you should know better, especially after all the money that you've made. So it's interesting times, but I think if it's what Scott Bessent should go back and do is focus on what he had promised. He had said that interest rates are going to come down because we're going to have lower deficits and we're going to have lower energy prices. So he hasn't really delivered on either of those yet, even though the Trump administration isn't spending money like the Biden administration was. We have to give them credit for that. But again, we've just got all of these entitlements that we're beholden to pay. So, but the marginal spending has come down a bit, and the money supply's already peaked. So things are heading in the right direction, but it's really tough to turn the battleship around.
I mean, you said
So,
earlier,
Yeah.
don't take on someone who's bigger than you. You remind me actually of James Carville, who I'm sure you remember used to be
Yes.
the political advisor to Bill Clinton when he was
Right.
president in the 1990s, and he famously said once that if I'm reincarnated, I originally wanted to come back as maybe the president or the Pope, but now I'd like to be reincarnated as the bond market because it can intimidate everyone. And you would think, wouldn't you, that Besant knows this is a battle that he can't
Yes.
possibly win.
Correct. Over time, of course not. You can win a few battles. You're not going to win the war. But he has other tools at his disposal, other fundamentals that he can work on. And I would suggest that, and I think he will, because he's a very smart man, but I think he's going to focus on the things that he can affect over the longer term, which is the deficits. And again, this war has gone on longer than anybody had thought, really. But if they get the energy markets functioning again properly, then oil's going to come off, and that will help as well, people at the pump. So there we are.
Has he let the genie out of the bottle here? Because now there's a lot more focus on this $40 trillion deficit than maybe there would have been before he intervened so sort of openly in the markets. I mean, this is an issue, hasn't it, that's always been in the background for years, but never really has made a big impact on markets. Now suddenly everyone is talking about this deficit, and now the focus is on Besant. So what are you going to do about it? You have the power to reduce this deficit and bring spending under control. What are you going to do?
He's done two interesting things. One is it has been kind of done before. It's a variation of what was known as Operation Twist, which is issuing short-term debt to buy back longer-term, higher-yielding debt. So he's doing that. He said he's going to increase the purchases of longer-dated bonds from 2 to 4 from here, 2 billion to 4 billion, right? In terms of their actual activities going forward here. So that's not as interesting. That's been done before, but it's showing that he cares. But the other interesting thing that hasn't really been done before, he's allowed the Japanese to use the repo facility but without selling bonds. So they can raise dollars without selling bonds. And this repo facility really was meant to be an emergency tool. But here, for the first time, it's really being used. I don't want to say currency supported. I don't want to say manipulation. That's a dirty word. But I think this is unprecedented. There's no other Treasury Secretary that's actually done this. So again, once you normalize something, then this is going to be a tool that is going to be reused or abused. So I think that's interesting.
And what does this mean then for the Bank of Japan? Because they're sort of on the wrong side of this, aren't they, really? If you've got, the US and Scott Bessent is almost acting like the governor of the Bank of Japan these days, wanting a stronger yen, and you've got the government, supporting that. The Bank of Japan is not really moving fast enough, is it? So does it put pressure on them, or do they say, we're not responsible for the exchange rate, that's nothing to do with us?
Well, there are a couple of things. One is they've been Scott Bessent has publicly said that the Bank of Japan is behind the curve, and I think that's blindingly obvious. Now, what we don't know is if there is any quid pro quo involved with this allowing of the Japanese to use the repo facility. So I doubt there is. I'm not privy. Nobody's privy to any sort of quid pro quo. I'd be very surprised if there was, but it would certainly give the U.S. a bit more leverage to jawbone the Bank of Japan to raise rates. And I think the Bank of Japan will raise rates. It's just they're going to do it in their own time. They don't want to be seen as doing something under duress. So if I'm Scott Bessent, I don't make any more comments about the BOJ being behind the curve. Just lay off the Bank of Japan and let them raise rates when they want to raise rates, which they will eventually.
I mean, as well as Scott Bessent sort of being at war with the bond markets and at odds with the Bank of Japan, he's also at odds with the Fed chairman, Kevin Walsh, as well, isn't he? Because Kevin Walsh only at the last meeting said he wanted the bond markets to do some of the tightening for him and to provide some of the signalling about where interest rates should be. But here you have Scott Bessent who's saying, no, we don't like what the bond market is telling us, and we want to change that. I mean, both can't be possible at the same time, can they?
If you remember, during the Cold War, people would always analyze who was standing next to the Soviet premier on top of Lenin's tomb. And in the hierarchy of Washington, D.C., Scott Bessent is really a right-hand man of Donald Trump. And Warsh really isn't yet. He may become that, but I don't think he will. But Bessent is really seen as an extension of Donald Trump at this point. So maybe Warsh wants to be his own man. Of course he wants to be his own man. So I think Warsh's view was he wanted to shrink the money, so just allow the money supply to contract on its own organically. And then from there, interest rates would likely fall as well of their own volition. I think that's his tactic from what I've seen so far. But he's certainly playing his cards close to the vest.
Yeah, we're going to obviously this speech at Jackson Hole on Friday is going to be very important, isn't it? And it'll be very interesting to see what the bond market reaction is to that.
Mm-hmm. Very good.
Let me
watch this space.
Yeah, let me just quickly change topics for a moment, because you're in the US at the moment. We have an expanding trade war going on now between the US and Canada. We just had overnight Canada announce its retaliatory tariffs. They say dollar for dollar, they're going to match the 50% duties that Donald Trump has imposed on them. I'm just wondering what the view is amongst the person on the ground, farmers, people who work in factories and in industry. Are they feeling this now, the impact of these tariffs and this trade war?
I've been spending time in the heartland here in the Midwest, Peter, and it's happy days. People are not concerned. They have jobs, they have excess, spending power. They're going out and enjoying their lives, and I don't think they're too worried. I think you get dulled to the constant headlines flashing up. This is a disaster, 50% tariff, everything's going to go up in price. These are negotiation tactics. These are not final tariffs. These are not finals. And, the tariffs eventually are going to settle in the high single digits for everything. So people are not putting a lot of credence in this. And as I said, we've got headline fatigue. Mm-hmm. So it's too taxing. It's too enervating to pay attention to what the 24-hour news cycle is saying. You know what? And the thing between U.S. and Canada, it's like a spat between cousins. But Mark Carney has to show some backbone and indignation and stand up to Donald Trump. At the same time, his kids go to school in the U.S. He's got a house in the U.S. It's kabuki. I'm in the U.S. I see kabuki drama everywhere from my upbringing in Japan. So I wouldn't put too much credence into it.
I mean, we hear a lot about how much this is damaging Donald Trump ahead of the midterms, but from what you're saying, it doesn't seem to be, or certainly not in the heartlands there where people are focusing on other things.
That's exactly it. So as long as people have jobs and they've got money, and everything else is elementary.
That's Dan Kerrigan, who's managing partner at Ohara Capital Partners. Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with this show. I'll be back tomorrow, where my guests will be Andrew Ferris, the CEO of Economist Advisory, and Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com. In the second part of the show, we look at some of the latest developments in emerging markets and fintech with Yanan Wu, the chairman and CEO of Surfing Group. Please catch me tomorrow.
Money Talk